Welcome, everybody. Today, we are talking about buy or sell. What part of the real estate market cycle are we in, right? We're always hearing about these cycles. I remember when we did that doctor's presentation thing, that guy tried to stump me with that question, and I was just like, I don't know how to answer it because it's complicated, folks, but we're going to uncomplicate it right now. You're going to really understand why we can't answer that question. If you just say, what part of the Yeah, no, we can't answer that question, and we're going to do it today.
You're darn right we are.
You're darn right you are. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC. Dressed up really nicely today, Greg.
Thank you for noticing.
Yeah. I call him GC because he's got the genius concepts. He can generate cash flow. He's a great co-host, and his name is Gregg Cohen. Say hello, GC.
Hello, everybody. Great to be with you.
Great to be with you all. And speaking of which, we are 3 days away from the Not Your Average Investor Summit.
Wow. Well done.
Yeah, you like
Did you
that?
practice that?
I just thought of that right now. It needs like a elevated announcement.
I think it was like summit.
Well, that was you. You missed the echo.
I screwed that one up.
Yeah. So 3 days away, big announcement. We got our speakers.
We
lined
do.
up. So you want to announce the speakers, GC?
Let's tag team it.
Panel of insiders out here.
All right. So many things to be excited for all of those who are going to be here at the summit. And one thing we haven't shared is those panelists who are going to be able to share with you what is actually happening in downtown Jacksonville. Yeah, I thought so. And so if you think about how special it will be to be in the room with these 3 panelists, it's not just about the projects that are being done. These are the decision makers, many of the decision makers that are shaping our downtown, and the amount of projects that are coming from these minds on this panel are factored into the billions of dollars as far as economic development in downtown Jacksonville. So super excited. We have the CEO of the Downtown Investment Authority, a friend of the show, Miss Lori Boyer, will be at the panel.
Only the diehard, not your average investor faithful. Remember that, because she hasn't been on the show for about 3 years. It was an awesome episode. So I'm pumped to find out, like, from there till now, how much things have changed. I'm really pumped to catch up with Lori.
Absolutely. And the Downtown Investment Authority, you'll learn more about that. But that's really the community redevelopment agency and the economic redevelopment agency specifically focused on downtown. So an incredible opportunity to hear Lori speak. We have Brian Mull, another friend of the show.
Another friend of the show. Brian, you'll be very familiar with. He was recently on the show. Good looking fellow that JWB figured out how to recruit from very highfalutin positions up by the nation's capital, bring him down to Jacksonville to lead this whole effort.
So Brian is the CEO of Gateway Jacks. Gateway Jacks has made a ton of news here in Jacksonville and across the country, actually, because Gateway Jacks is rolling out the first phase of a $2 billion redevelopment project in the heart of downtown Jacksonville. Of course, this is what JWB was a part of setting up. We scoured the country to find the best and the brightest. We're so happy to bring Brian and his team here. And oh, by the way, if you're wondering if this has ever been done before, it has been done before by Brian and his team. The Water Street District in Tampa is the development that Brian headed up before. So
So we keep talking about Water Street in Tampa because it's so familiar to us.
Right.
But he's talking about that development in DC that he did around Amazon HQ2.
Exactly.
As being like another one-to-one thing of like urban renaissance with adjacent neighborhoods having this like amazing uplift.
You should have been on the call that we had yesterday with Brian and his team. He was so excited to be able to share not just the vision for downtown, but how it connects to investing in single family rental properties as well. And then last but not least, we have our president of JWB, Alex Zafakis, the visionary really behind all of these great things coming together. Alex is going to be on the panel with us. Always a special time when we get my buddy up there.
Some call him the dream weaver. Some call him the Tasmanian devil of real estate. Some call him the Steve Jobs of Northeast Florida real estate.
Ooh.
Yeah. Alex is a good time and the ultimate insider secrets. So you're very familiar with Alex. He pulls a big crowd out here. I'm pumped to get that going, man. I think it's going to be a really cool conversation between those 3 in the room. And, together in that room, we have 3 people that have their thumbs on the scale of billions of dollars of economic development, which I think is a special thing.
You are in such a special place at such a special time. here for the summit. This is something that if you have an interest in community redevelopment and how cities become better versions of themselves, and if you have an investor mindset, there's no better place than you can be here Friday and Saturday for the summit. So super excited. For anybody who hasn't joined the WhatsApp group, would highly encourage you to do that. There have been emails that have been sent out with all the information as far as parking, how to register for the WhatsApp group. Just a special note on parking. There is no parking here at JWB's offices. You're going to be parking at a special place, the Park and Ride, which is right down the road. We'll be shuttling you in. So I know a lot of folks will look up the JWB address. You're not parking here. You're parking at Park and Ride because we have so many people coming for the summit that our parking lot can't handle it. So for any details there, please check the emails and join the WhatsApp group, and you'll stay in the know. And we'll see you soon.
All right, JC, you know what I'm excited about.
What are you
right?
excited for?
You know, just a small reunion of a select group of people with extraordinary nicknames that have all been bestowed in a little tradition that we have, which is what you see.
The roll call, baby.
The mystery man saying 2 days.
That's right. Denny Davies.
Denny Davis in the house. We've got Marilyn Cotterman from Homosassa, Florida.
That's the home of the manatees,
Home
Pablo.
of the manatees. I wonder if she's swimming with manatees right now. Marilyn, good to see you checking in early like this. We got our usual leadoff hitter, batting third today.
John Henning.
John Henning. We got the Shawman.
Nadeem Shah.
We got the ringmaster.
Drew Barnhill.
We've got Laura Colby from Washington State.
All right, Laura.
Laura's back. Laura, good to have you here. We got Stephen Chmielewski from Providence, Rhode Island, building a snowman shortly.
All right, Steven. Good to see you, buddy.
Very different than what we got going on inside. We got the patron Centaurus of Northern Virginia.
Michael Santorios.
We got the better Greg.
Gregg Stone.
Greg Stone, howdy from a snowy New Jersey, 8 inches.
Oh my
Holy
gosh.
cow. That's probably what they mean by building a snowman.
Yeah, that nor'easter, huh?
We got Linda Heng saying good morning to all.
New name.
New name.
All right,
New name.
Linda, welcome.
Good to have you. Good to have you. We got the Maven from the mountains of Denver.
Leslie Wilson.
Leslie Wilson. We got our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
Who else we got in here? We've got Derek Tubman from the west side of Jacksonville.
All right,
Another
Derek.
name.
I think Derek's been around.
Derek's
I
been
could be
around?
wrong. Derek, let us know if this is your first time.
Derek.
And either way, welcome.
Good to have you. We got our amigo in the house.
Bill Shields.
Bill Shields with a buenas tardes, amigos. We've got Big Papa's in the house. We love it when he calls in Big Papa.
Pops, how are you, my friend?
The co-founder of the co-founder, Jay Cohen. Good to have you. Stanley Jocelyn is back. Good
All
to
right,
have
Stanley.
you, Stanley. We got the mountain man.
Billy Green.
Good morning from the insistently moosey mountains of Colorado. All right, you got me on that one. I did not know if
Keep
I
it coming, Billy.
insistently
Keep it
correct,
coming, Mountain Man.
but I need a thesaurus. Joel Wixel in the house.
All right,
from,
Joel.
from one of my little favorite
right.
stretches of coastline.
Santa Barbara, baby.
Santa Barbara. Good to have you, Joel. We got Sergio Prieto.
Go Gators.
Who else we got in here? Eddie Harris from you know where.
Atlanta, baby.
Atlanta. Good to have you. We got the patriarch and matriarch of the first family of the Not Your Average Best Show, Ken and Carolyn Moline.
We salute you.
I think we did that well.
That's good.
We got Chris Lee from Fernandina Beach.
All right, fit.
We got our boy Pedro Nasanciano from
Jersey.
Jersey. Good to have you. Charity Graham in the house. Charity, good to have
Hi,
you
Charity.
here. All right. Tim Hoving. And Tim and Lorraine from
All
Washington
right.
State.
New name?
New name.
All
a new
right. I love
family.
that.
I love it when people join in this couple. So
Nothing better.
we're getting a nice little Washington State contingency.
I
happening.
agree. I agree.
What is
This is
happening out there
wonderful.
in Washington State? We love it. Love to have you here. And John Lopez with a good morning. John,
Hi,
good
John.
to have you as well.
Good
And of course,
morning.
we got the Mama Bear,
We do, of course. Miss Cody Adams.
Cody Addings. And you know who else we got? That keeps checking in as JC
Mhm.
here in the thing, but I figured out who that is.
Who is that?
It's Jag Chatham, my
No
lady,
way.
Jag. Yeah.
Fantastic.
Who's
There we
coming
go.
to the summit, Jag. I can't wait to meet you.
Wouldn't be a summit without you.
We got Lisa Moffett from Reno, Nevada. Another new name. Bunch of new
that.
names. Would love. Let
Thank
us
you
know in
all.
the chat. What made you decide to join today? This is extraordinary number of new names that are not just showing up, but showing up and putting your name in the chat.
Courageous
That
new
is
names.
courageous new names. That's what I'm talking about right there. All right, GC. Let's get to the subject at hand. But before we got breaking news today.
We do. Best
we-
type of breaking news. Just a shout out. Some of the good things that are being done for clients as a part of our network that you would never even ask questions about or expect. And whenever I hear a story, it might be something big in terms of this thing or that thing, but it's a huge impact if you're the client on the other side. And so I wanted to bring it to light. You know, as many of you know, when you invest with JWB, we're going to set you up with a lender in our network of approved lenders. And our lending team goes to an incredible degree to make sure that the client has a wonderful experience, low rates and all that good stuff. Sometimes what you may not know is they're always paying attention to make sure that they can get the best rate for you all the way through the closing process. So it's not just the one that's quoted when you lock your rate in. What can we do to increase or to make the terms better, to decrease your rate, your interest rate? Well, here's a small story. We had a client that was going to closing, a few days away from closing, maybe. And our lending team said, you know what, let's go ahead and rerun their credit just one more time to see if we can bump their credit score up just a little bit. We knew if their credit score bumped up a little bit, it could mean that their interest rate would decrease. And so the lending team didn't ask the client, well, of course we had their approval to run their credit, but didn't ask the client for the additional cost to rerun the credit. We just bore the cost. And then we reran the credit. The credit score jumped up and their interest rate was able to drop from 5.78 down to 5.625. That's huge.
That's huge.
In the first year, that saves $225 in cash flow for this client.
Nice.
Can you imagine being a client on the other end?
Yeah, I can imagine it because one of your mortgage lenders found me a way to save 0.8% on my mortgage on my purchase. So I'm starting to see a through line here of this idea that, you know, we talk all the time about how you have these pre-approved lenders and people sometimes push back, why can't I use my own lender? And you always talk about this idea that you need to control the experience here. This is not a typical loan, and you need to work with partners that understand how to get this thing to closing and bring the most value to the table as possible. 100%. And we're starting to get all these data points about how this network of lenders that JWB has really knows what the heck they're doing.
It's the magic of this vertical integration. And, you know, if you're outside of this, then, you know, maybe your lender doesn't think to run it again. Maybe your lender runs it, but they have to charge you for it. None of those things happen for our clients. And so excited for that client who was able to have an even better experience than they were expecting. And so proud of the team that we have to be able to serve our clients.
Love that. That's a great story. That's a great story. By the way, I missed Vig Mudrick from Richmond.
All right, Vic.
In the
Long-time client.
Call. Yeah, Vic's been making a habit of being here. Jag is saying, can you please offer an all-in-one loan lender on your properties?
An all-in-one loan lender. You know, I wish it was that simple. The reality is if there was going to be an all-in-one loan lender, the terms wouldn't be nearly as advantageous as they are right now. So I know the lending process is not the most fun because it involves getting a bank to give you money, and that's never fun. But trust me, when you buy and you hold and you see the value of you getting the absolute best terms, lowest interest rate you can, it's worth the temporary pain to go through it. So sorry, Jag, but that's the reality.
So you basically, you keep it competitive in order to continue to like drive better performance. Yeah.
I mean, you can go to different lending options. We could provide different lending options that were somewhat easier, but at the end of the day, if that's a half point higher of interest or maybe a full point higher, you know, that's really going to cost you over a buy and hold period of 5, 10, maybe 30 years. And so that's why it's worth it for us to work within the confines of the conventional loans rather than something that is what Jag is asking about.
Got it. Okay. Good to know, man. Ready to kick off the
I was born ready, baby. Let's do it.
All right. Oh, by the way, Brian and Liz Boyer from Rockford, Illinois. Another couple, another new name.
What do you know?
This is amazing.
And if you're new and you haven't said hello yet, please do that. We have such an amazing community that would love to welcome you. So thank you to all of you courageous folks. And for all of you who haven't said hello yet, now's the time.
Yeah. And listen, the value of being here live, right? Like we take it real seriously. We always thank everybody at the end of the thing of like being here for a full hour. But the real value to you is the fact that right now I'm looking at the chat. There is over 90 people in this chat. Out of that, exactly 3 of us work for JWB, right?
Yeah.
So the value of just like interacting in the chat, getting somebody's, you know, getting someone's opinion on whether or not like what we're saying is true or it's true for you, or if it's the best idea for you, or maybe they have another suggestion for you in there, right? So like the activeness on the chat to me is what makes this thing magical and what makes it really like worth it to take an hour out of your day to show up and special, right? Like real friendships have happened here. I think this summit that we're about to do is an absolute testimony to that. So tons more. Christy Mitchell from Northern Utah, second time. Good to have you, Christy.
Right.
Edwin Sharon. Look at this from Atlanta.
This is fantastic.
I guess this is driving great behavior. Shaquille Ahmed is first time joining. Looking forward to jumping in very soon. Okay, I love this. I love this. All right, let's get going. We really appreciate you. Keep this thing going. Say hello. Ask the questions that you got. We got a lot of knowledge in that chat. Speaking of knowledge, Genius Concepts, GC is what they call you, right?
Yes, now that you started that, yes.
Yeah, I like starting stuff like that. Actually, I didn't start that.
You didn't start that?
Our friend Zach Correa started that in the chat.
That's right. That's right. That's right.
Genius Concepts. Okay, so that being said, the real estate cycle, the market cycle. Let's talk about it, man. Is it really a cycle? Like when I push to you like this, like what state of the real estate cycle are we in? You're like, oh man, like that word. Yeah. Talk to me about that, DC.
It's always pained me because, there's a lot of terminology that is used across multiple asset classes, but for certain asset classes, it evokes one thought process or one emotion, which may not be relevant to another asset class, but we all call them cycles, right? So when I hear, what real estate cycle are we in, it starts to make me cringe a little bit. And it's because let's separate real estate here for a second. In a typical cycle, what do we think of? We think of there's a period of growth. We think things are appreciating, whatever that asset is, things are going up. And then we think the next phase of the cycle is things are starting to come down.
Yeah.
And then we think the next phase of that cycle is things are losing money now. And there's a bottom, there's a trough. And then we think it then recovers.
Yeah.
Right. So that's what a typical cycle may be. I would imagine if you're on the show right now in the chat, this is what you may be thinking of a typical cycle. And so you can see here on the chart here, right? This is just a rough sketch of what a typical cycle is. A full market cycle, it starts, you have a bull market, it reaches a peak. And then what happens after the bull peak?
It goes down.
It goes down below where it originally started. And you have a bear market and a trough.
Yep.
And then it then comes up.
Correct. When I think of a cycle, and I think of it in relation to like what I'm used to in the other asset classes before I got educated on real estate, and I look at this graphic, I cannot help but think that inherent with believing things come in a cycle is inherently the psychology of buying the dip.
Yes.
Where can I get the deal?
Yes.
How do I get in when it's at that trough? And that is pervasive in all of this stuff.
Right.
Which I think is what we're going to start to understand is the problem with thinking about it that way in real estate. Because I believe that, and we're, going to go through this data, but I believe that 2008 conditioned us to actually see it this way, when in reality, 2008, I don't think it was really part of the cycle. I think in 2008, all of a sudden, we were just in a different orbit. It was a complete outlier.
100%.
And for one time ever, this one thing happened. But since it's in our lifetime, we still have that tacit kind of like knowledge and experience that makes us, that gives us, what's the word? It's availability heuristic. If you're exposed to something,
right,
you believe it to be more frequent than it may or may not be.
That's exactly right. It's like because we experienced 2008 and it was something incredibly personal and emotional to us, which is our homes.
Yeah.
We totally forgot about the previous 30, 40, 50 years of data as far as how real estate actually works as far as home prices.
So if it doesn't work, if cycle isn't the word, GC, how do you describe the way that real estate as an asset class performs?
So real estate as an asset class is less of a cycle in the thought of it going way up and way down. It's less of that. It's more of a recurring pattern of growth. Over the long haul, real estate goes up in value because it's a critical need for the individual. It's a critical need for the government for it to work. And so what you see over time is you do not see what a typical market cycle would be. You do not see periods of huge growth, and then you do not see periods of huge loss followed by a recovery. In real estate, it's more of a recurring pattern. It is more of a recurring pattern of relatively small growth percentages. Okay, so it might be 3% growth, 4% growth, maybe 5% growth year over year for home prices. But the kicker is in real estate, you get the benefits of leverage as well. So those 3% growth, 4% growth, which is consistent, gets multiplied because of the benefits of leverage. And so we can pull up a slide here to kind of illustrate the points. But real estate cycles really are different. And it's less of a cycle here, right? It's a recurring pattern of growth. What I'm showing you here is from the Federal Reserve Economic Data Branch. It's housing prices for Jacksonville, Florida from 1978 all the way through current day. And so this is what you typically see in real estate. Slow, recurring pattern of growth. Now, for all of us who were here in 2008 and investing in 2008, you did have a time when house prices went way up and then house prices went way down.
Yep.
But that is certainly not the norm. That is the aberration, and that was an anomaly.
Got it. So if we were looking at another, if this chart that we're looking at, if you're listening on the podcast, we're looking at a chart that shows house prices over time. It is a very nice and boring, steady drive up. There's a big lump in the middle here, and then it continues to go up, and then there's clearly an accelerated rate at the bottom here, which I'm assuming is post-COVID, kind of have home prices shot up, right?
Exactly.
If we were to look at something that truly is cyclical, less of a recurring pattern and more of a buy the dip kind of cycle mentality, we'd be looking at, also a trend, but there would just be much more fluctuations of ups and downs in this chart. Is that what you're saying?
Yes, exactly.
Okay, cool. So let's take a little closer look into this thing, right? You see, because we did see that bump and that way down in 2008. Can you explain that to us and how that doesn't constitute that we are now in a cyclical economy?
Yes, absolutely. So 2008 was an anomaly because real estate caused the Great Recession. And if you look at other recessions, going back on that chart, it actually outlined it was shaded when other recessions happen. Other recessions, real estate values go up. There was only one recession where real estate values went down, and it went back and went down in a large way, which was the Great Recession. And the Great Recession was caused by real estate. And so, we had a lot of loans that were made to people that shouldn't have been getting loans. And when you make loans on real estate and you use leverage, it can be a double-sided coin, right? It can be the other side of leverage is if you start making a ton of loans that you shouldn't be making, that can amplify the negative effects of real estate as well. And so that's what happened in 2008. But there has been an incredible amount of government regulation and banking regulation that has gone in to prevent that sort of thing from happening right now. If we go back to Jag's question right off the bat, hey, can I find a lender that can do all loans in one? She's basically saying, can I make it an easier loan process? Well, it's a challenge. It's taxing. It is not fun to actually go and get money from a bank right now, which is the way it probably should be. Right. In 2008, it wasn't that way. So if you can have that lens, that perspective that what happened in 2008 was an anomaly, was not normal, and you can section that out from the rest of the 40 plus years of data that we have for home prices, then it makes it more clear as to why that's different. That's not normal. And the rest of the data supports this recurring pattern of growth in real estate.
So this is this chart that we're looking at now. We've looked at this for the last 4 years. We've been updating this chart, right? And you see in a very zoomed in way, you see these little ups and downs, right? It's much less. This is essentially monthly, quarterly. What is it? It's like a monthly.
Quarterly.
Yeah, it's like a quarterly zoomed in chart of fluctuations. And you do see this pattern, this bubble that arises above a median trend line, right? What is this median trend line here, GC?
So that is taking the home prices and assuming that they increase at 4.8% per year. And the reason that 4.8% is significant is because if you go all the way back since 1982, 40 plus years of data, the average annualized home price appreciation for the Jacksonville market is actually 5% per year. But internally, we actually use 4.8% because we underpromise and overdeliver. So that 4.8% line is saying, well, that's what prices should be at if they continue to appreciate as they have on average for the last 40 years.
Got it. So if we look at the last 23 years that are plotted on this graph here, we see this median trend line that holds true if you look at it through a full, market cycle timeline, right? And we see the Great Recession happen, right? Like we see this idea of what everybody was talking about, a bubble. We see this thing trend up way above it and then come right back down and then go way below this median trend line. And then the rest of the time it's just been appreciating at the same kind of rate with a little bit of increase over here in 2020. How do we know, GC, that this bubble that we see come over the median trend line is not the same as what we just saw in COVID happen when we just realized that everything accelerated and there was this blip up here?
Well, there's a lot of things that have gone into understanding that where we are today and where we have been for the last few years is not the Great Recession. This is why we came so strong on the show 3 years ago and said we did not see home prices declining when the rest of the world said that they were going to. So there's a lot that goes into that. We'll talk a little bit about months of inventory and some other things. Yeah. But one thing that you all can look at here right on this graph and know that it was different is look at the percentage that home prices are above that projected line. If you go back to 2006 and 2007, you see that bubble that was formed. Well, I don't have the exact percentage, but we'll just ballpark it here. The median home sales prices right there were about 50% higher than what the projected median home sales price was, right? When you have your actual home price being 50% higher than what it's expected to be, that is a sign of potentially a bubble. And that's what was proven to be true.
Yeah. And just for those at home that are listening on the podcast, right? Like there's a red line going through, like a steady, like 4% red line. And then there's this like ascending line that creates this bubble. And what it shows at the peak of the bubble is essentially, the median home price being somewhere, what would you say? That's like 215,000, something like that.
Yeah.
Somewhere around there, 215,000. And if you look down at this red line, it's pretty simple to see. It's about 150,000, right? So like you're basically like $65,000-$70,000 over the where it should be on the trend line. That's that 50% difference between where it is and where it should be.
Exactly. Well said.
So then when you look across and you see, to the naked eye, the blue line, which represents what the actual median home price is, and the red line, which represents the trend line, right, where it should be, the space from the red line to the blue line in 2022 looks comparable to the space between the red line and the blue line, right? It doesn't look as much, but it looks comparable. But at the end of the day, what we're talking about is a trend line that has the median home sales price at like 305,000 and where it actually is somewhere around 360,000. So like maybe it is a $50,000 difference, but now it's not 50%.
Right.
Now the actual price of what it is not, there's not that big of a variance.
It's a really well stated point that we haven't specifically brought that up on the show. So it's a new nugget. And I'm so glad that we're going a little bit more in depth there because there's a numeric quantifiable way to say, is this a bubble or not? And this actual price over the projected line is one of the tools you can look at. It's one of the tools that we looked at and said, do we see home prices going down, up, sideways? This is one of the tools that are allowed. So, you had maybe 50% above the trend line in 2006 and 7. Maybe you have somewhere around 15%.
Yeah.
Here,
difference.
Right?
Yeah.
Very within the range of
15% at the top of the difference, right? Right now it's cooled back down. It looks maybe like 5%.
Exactly. This also has seasonality that comes into play there. So home prices are higher at different parts of the year. So yeah, feel good about sharing that with the group.
That's good. That's a great insight because we've shown this. Denny is talking about how like this is by far the most important of Gregg's hundreds of charts that he produces. It's the cha-ching of charts.
I love that.
I like that. But yeah, we've seen this chart a lot, and we talk a lot about this idea of data with perspective. That's a whole bunch of data there, right? Like, and the idea that the perspective, because up until right before this show, when you were explaining this, I'm like, yeah, man, but how are we going to talk about that this isn't a bubble if that difference is the same? But it's, again, that factor of difference between median sales price and projected sales price based on 4% appreciation divided by the actual projected sales price.
Yeah.
And that is not a very big difference. Whereas back in 2008, that was a 50% difference.
Exactly.
Right. So then that tells us we are not in a bubble. We are in typical behavior, which means we are again in a recurring growth pattern.
And
not
what
a cycle.
happened? What happened last year is the rest of the world said home prices were going to crash. We said home prices were going to normalize. We saw slow, recurring, positive appreciation on Jacksonville home prices. This is part of the reason I was able to say that.
Got it. So then as we zoom out, right? Like right now we're zoomed out.
Mhm.
We're like, no, we are still in this repetitive pattern of growth.
Mhm.
This is the reason why I think that that famous phrase that people talk about, it's not, hey, should I wait to buy real estate? It's I should buy real estate and wait,
Yes.
right? Because if you believe this, if there isn't a dip, right? Like if the one dip that ever happened once in the last 70 years, right? Like you're so now if you're thinking about waiting for like the moment where things are going to drop, that is erroneous thinking. You should be back into the understanding that there is a recurring growth pattern that will continue to happen. And therefore, if you are attracted to the asset class of real estate, you're attracted to this idea of like a pretty high growth, 9 to 11% return, which most places would kill for, as long as it has a very, very risk mitigated part of it, right? Like a very high floor, plus all these other flexible options that come with the real estate, then you shouldn't be thinking of like, should I wait? You should just be like, okay, when can I get my ducks in a row to get in on this?
Exactly.
And that becomes a question that, that's why chatwithjwb.com exists, because now if you're in that moment where you're just like, okay, I don't really want, I'm not looking to wait. I'm not looking for the right moment.
Mhm.
I'm just looking at, do I have enough in the bank to do this? And are there people that can help me figure out if I have enough and this and that? Then that's when you go to chatwithjwb.com, you schedule a call and you talk to an expert here in-house that helps you identify that stuff like you've done with thousands of other investors.
Well said. Well said. Right. I think this isn't to say that real estate values can never go down or that they never go down, even when you don't have, the Great Recession, right? Real estate values can go down. It's just extremely unlikely based on the data.
Mhm.
And as investors, you're always thinking about your opportunity cost.
Mhm.
And so if you're sitting here and you're saying, well, I really love this asset class, but I'm going to wait until home values go down in order to jump on it because of this buy the dip mentality that works in other asset classes, you're probably not going to see that happen based on what the data shows.
Mhm.
And what you should also be considering is what opportunity cost are you giving up? Think about it 3 years ago if you listen to everybody. And you believe then this idea that home values were going to crash at that time, and you did not buy at that time.
Yep.
You would have given up, depending on the asset, tens of thousands of dollars already, maybe hundreds of thousands of dollars already, because you were buying into this cyclical buying the dip mentality that works elsewhere.
Yep.
But it doesn't work here, and it costs you the longer you wait to get into this asset class.
Got it. Do you see, we have a bunch of really good questions in the chat. So right now we're talking from like a big picture mentality, and we're going to get into some of the like more short-term indicators of how Gregg has in the past multiple times when the world said that everything was going to crash, AKA the week of COVID. And also as like interest rates started going through the roof, the statistics that he has been able to like rely on to understand the short term of it. But I think before we get into that, I think we can handle some of these questions.
Cool, let's do it.
To give people some good perspective. The first one is Shaquille Ahmed, who says, actually, this is short term. I guess you might get to this, but what do you see forecasts on prices and ROI in the next 2 to 5 years? I say we save that for the months of inventory discussion. Vi Desai has a question. Do you still have new builds that are under construction, and are you expecting rents to drop? My Phoenix rents are dropping.
Yes, we do have new construction and we also have renovated homes. We love them both. Are we expecting rents to drop? No, we're not expecting rents to drop here in Jacksonville. That can't happen in other parts of the country, but we're not expecting that in Jacksonville. And the data and the consulting that we rely on also is expecting normal rent growth in Jacksonville in 2024 and 2025, just like we saw in 2023.
we just did a show, or do we have a show coming up? I feel like we just talked about this of like, oh no, we have a show coming up of the relationship between prices and rents and how that interacts. The punchline is prices and rents go up at the same time. Like they continue to increase. You've got a stat about like rents nationwide or something like that.
Yeah, rents across the country have never gone down year over year at any time on record. Let me just say that again. Rents have never declined across the country year over year, right? Any year on record. So again, playing the odds here, really unlikely that you're going to see rents come down across the entire country. But you do need to have boots on the ground. You do need to have an expert in that specific area that you're investing with. We happen to be that expert here in Jacksonville, and we're not in Phoenix. So if you're putting your money in Phoenix, I would try to find somebody who has access to this type of information there too.
Yeah, correct. And so Jack is saying in the chat, some places are seeing rents drop, right? Like what we know here is that you have a data flywheel of JWB rents over 6,000 properties, right? Like they property manage over 6,000 properties and have data on all of these. And what we see here is that there continues to be a shortage of housing for the amount of people that are looking for rentable homes because Jacksonville is still growing at a very rapid rate. We're in front of a bunch of these trends, right? Like we've had the really good weather and the tax-free status and all these different things. And as the market continues to mature here, it's still also, you know, Florida being this very attractive state, this is the cheapest major metropolitan area in Florida, right? So if people want to move to Florida, they don't want to move to Hairy Knuckle, Florida. They want to move to City, Florida, which is Orlando, Tampa, Miami, South Florida, and Jacksonville. Jacksonville still continues to be below the national median on home prices and cost of living.
100%.
So we are experiencing a more elevated growth rate than all the other cities because of that.
Absolutely.
Cool. So, all right, there you go. So we don't see rents dropping. Anonymous attendee, checking in from France over here, says, I bought a townhome in 2021 and I'm struggling with selling soon and cashing in on equity now or continuing to let the equity grow. General thoughts.
Oh, man, I tell you what, you know, when I started in this business, my whole goal was to build up this army of income producing assets. And I think people discount just how much work, courage, capital, discount the amount of the qualities of the financing that I got in place to put a deal together and buy a real estate property. And I just have such great respect for buying that because your goal here is to stack income producing assets and hold on for a full market cycle. You know, so that's my general thought is when you go through all the effort of actually acquiring that income producing asset, put that into your army of income producing assets. And of course, you need a great partner to make sure that the experience is enjoyable. That's why we're working with a vertically integrated team is a part of this decision for you. But buy and hold and just let this asset work for you is the advice, the general advice that I give. If there is something that is really pressing, that is urging you to sell, if you really run the numbers, it's usually not your expected return on investment, or at least your risk-adjusted return on investment. That's usually not what people drives them to sell. It's usually something temporary, which is more cash flow related, which comes down to the quality of your vertically integrated partner. And so if you have a real desire to sell and cash out and do that, I would just want to understand why. Do you have a better risk-adjusted return out there? Well, that's certainly something to consider. It's usually harder to find that when you actually run the numbers. And then if you just don't have the right partner in place, start there. Find the right partner so that you can just keep stacking victories in your army of income producing assets.
Yeah, that makes a lot of sense. And I think so people are chiming in the chat, this idea of like only JWB does a 2 to 3 year lease, you know, have not seen any other management doing that. Jag is saying bad property management equals sell, not in Jacksonville. And what they're saying essentially, what Gregg is, you know, being real humble about is this idea that if you're having a bad experience with a property manager, that is the number one thing that drives people to sell, right? Like it becomes too active. You have a bad short-term situation. Your property manager didn't get the right person there. They're not managing it well. You're having high turnover. It's become a headache. It's too busy for you. JWB has built a business model to make this thing as passive as possible by not just being a turnkey rental property provider, but by building one of the biggest single family home rental property management organizations in the country here, all in Jacksonville. So if you are in Jacksonville and you're having that experience, you can always switch over to Jacksonville as property management. Or if you want to stay in real estate and continue to have this upside and your property somewhere else and you have a bunch of equity in it, you can always do a 1031 exchange, sell that thing, move it tax deferred, and buy properties with JWB that will allow you to stay in the asset class here in Jacksonville where you have a general higher home price appreciation as well. Those are all the types of questions that like you can get answered, like the hows in at chatwithjwb.com if you want to book that call and see what that could look like.
Well said. I'll just add some numbers on it. Many people aren't aware that we do the management of properties that people don't buy through us. We opened this up a number of years ago, and it's become a major part of our property management business. So over 25% of the homes that we manage are actually through clients that did not purchase the home through us. So if you're one of those folks and you just want this expert property management done for you, we can be that solution for you. And you can go to chatwithjwb.com. You can send an email. Sometimes that's easier. You can just send an email to info@jwbcompanies.com and we'll get you at the right place.
Gotcha. Shaquille Ahmed says, my thought, real estate minimum ideal hold time, 5 to 7 years. What do you say about that?
At the very minimum, the reality is the best returns come from you from holding on for a full market cycle, which is known to be between 10 to 20 years.
Yeah, correct. We talk about this idea. I mean, I know that at Chat with JWB, they're going to be like, listen, if you're not thinking about this in at least 5 years, we're probably not the right solution for you.
Right.
You want to be here long term. But we talk about the idea of like these trends and all this stuff normalizes within the 10 to 20 year period, right?
Mhm.
So 5 to 7 is a really good start. We like to think of it here as long term as possible.
There
right?
you go.
Okay, cool. Let's get into, we'll go back to questions in a second. I want to finish on this data. But before we go there, there was somebody in the chat that asked something pretty profound, which I think we need to hit on. Cal Frank says, what's the significance of the chart? I'm thinking of buying property, but not sure if it's a good time to do so. How would you answer, if Cal didn't really get it that first time around, like the significance of this chart is what, GC?
The market is performing as normal.
Yeah.
And it's going to perform as normal over the next 10 to 20 years that you hold on to this property, just like it performed as normal over the last 10 to 20 years. If you actually run the numbers, you'll see that the actual home price appreciation is really close to what we would have predicted 20 years ago when you take all of the ups and the downs there. So the reality here is that buying and holding for a full market cycle, it's like you already know the answers to the test.
Yeah.
And these returns on investment in single family rental properties are better than most asset classes. And there's risk mitigation built in. So this chart is not to say that this is the only best time to buy.
Mhm.
They're saying that the best time to buy real estate was yesterday or today, right? So that's what I would encourage you to do.
Yeah, Colin, what I see in this chart, if I'm looking at it from my eyes and based on your question, I want to buy real estate, not sure if right now is the right time. What this chart tells me is that there is not going to be in the short run, there's not going to be like a fire sale of real estate,
No.
right? So like if you want to buy real estate and you're wondering if it's the right time, the answer is yes, because you said you want to buy real estate. And right now we're looking at in the short run, there isn't going to be on the passive side, a moment where you're going to be able to like capitalize on some kind of like giant dip.
Mhm.
And that's the point we're trying to make. And there's no buy the dip here that should be normalized the way that it's normalized in other asset classes. It is buy when you're ready and buy when you're interested and once you see it
Mhm.
and then hold on and then
Mhm.
figure out how to hold on as long as you can.
Exactly.
All right, GC. So let's keep talking this short-term stuff. We'll go back to Shaquille Ahmed's question. I guess you might get to this, but what do you see of forecast prices ROI in the next 2 to 4 years? I think it's time to talk about our old friend, MOI.
There we go. Happy to do that. Would you like me to answer that directly or just go through it in the context?
Why don't
of
we
this?
go through this in the context of this and then you can speak directly to it.
Love it. So, as we have gone from macro, how to think about real estate more as a recurring pattern of slow but repeatable growth in terms of home price appreciation, we could go a little bit more micro into how are we doing? What part of this cycle are we, or what part of this recurring pattern of growth are we in? One chart to be able to do that was a chart that we just looked at that we just looked at.
Mhm.
But there's a whole nother world here that you should be looking at. And we talk about it often. And it's so amazing that we have over 90 people attending live on the show here. Some of you are brand new and you've never heard me talk about months of inventory.
That's right.
But our veterans in the Not Your Average Investor community have heard this over and over again. And it's so important that we go into it all the time.
Yeah.
Months of inventory is the tracking of how long would it take for the market to be exhausted, for all the properties on the real estate market in your area to be exhausted based on the current rate of sales. And if you track it over time, this is an early indicator for what home prices are going to do, call it over the next maybe 6 to 12 months. This is another tool that we use to be able to see what is going to happen with home prices in the very near term. And so all you do is you take the number of homes that are on the market, divided by the number of homes that sold last month, and you're left with a number. And this number is your months of inventory. And if that months of inventory number is less than 6, you would expect higher than average home price appreciation, call it over the next year. If it's between 6 and 7, historically, you'd see about average home price appreciation. What's average home price appreciation?
We just talked about in the chart, 4% in Jacksonville.
I'm going to give you one more try.
4.6%.
I'm going to give you another
5%.
The actual average home price appreciation in Jacksonville over the last 40 years, 40 plus years is actually 5%. But when we started, it was less than that.
It was 4.6.
It has gone up over the years. So that's what you would expect between 6 to 7 months of inventory. And if you get up above 7 months of inventory, that's where you would expect lower than average home price appreciation. It does not mean a decline in home prices. It might mean 3% or 4% or 2%. And as you get farther and farther away from 6 to 7, that's where you start to see a quote unquote bubble potentially starting to form.
Got it. So that is the stat that when we first started this show, for those of you that are new, we started this show January 2020.
We did.
So as you can imagine, as March 2020 rolls around, we're just kind of like getting into this. Greg and I barely knew each other.
Yeah, we did.
We're getting into this. So like, yeah, we got a community and we got a show. We're talking about stuff. All of a sudden the world ends.
Yeah.
Right. Like where we were yesterday was all of a sudden we're in complete outer space. And as everything is melting down around us, we knew that there would be a lot of eyes on the show. And that's what happens. That's when you are able to host a community every single week and you have a press conference. You get the most people when stuff goes wrong, right?
Yes.
And stuff went really wrong. And I was going into this thing and we're just talking about, he's like, hey man, I know that everybody's freaking out here, but I just don't think prices are going to drop. Like if you look at this months of inventory thing that we have, I don't think it's going to happen. I'm a little bit nervous talking about it because I don't want to, because I'm flying in the face of everybody out there in the media, but like, this is what we look at. I'm like, Greg, go for it, man.
You did.
And kudos to you. You leaned into it, right? So like, this is why we call this the Not Your Average Investor Show. It's because you're not getting like an average real estate kind of perspective here. You're getting the perspective of somebody that thinks independently, has his own data, makes his own decisions, has been doing this for 17 years, and has now built, is now, part of more than $1 billion worth of assets in transaction. And this is one of like the big marker stats that our community has really grown to understand and love. And let's dive into it, right? This months of inventory right now in 2019, again, you divide the houses on the market by the total sales previous month. 2019, it was at 3.19, which is considerably below the median trend of 5%, right? You look at January 2020, again, you divide the same thing, you're at 3.0.
January 2023.
January 2023.
Yep.
I'm not a numbers guy, Greg. I'm a story guy. And we're at 3.06. And we look at January 2024, and we're at 3.24.
I think it's interesting. What has the narrative been around real estate in January 2019 versus the narrative around real estate in 2023 versus narrative even now?
January 2019, real estate looked phenomenal.
Everybody wanted to buy real estate then.
Everybody was buying real estate. And somewhere in the last year or so, the media has completely turned on it and said impending crash. Like you get all these different headlines of like all this impending doom and gloom. And yet when you look at these numbers here, that MOI indicator is staying as saying prices in Jacksonville do not look like they are going to drop anytime soon.
Just to put this in perspective, it is so unusual to see home prices, to see months of inventory in the low threes. It's so unusual. Before this, really, we started tracking this in 2014. Consistently, it's in the fours, fives, sixes,
Yeah.
somewhere around there. I don't even think we saw it in the threes for many, many years. And now it's still in the threes, which means that we have a supply challenge. It is a problem for America because we don't have enough housing supply to support the demand for housing. But for you as an investor, it puts you in a position of strength when you own the asset. It's like any other business. If you have the stuff that there's not enough of, you're in a position of strength.
Yeah.
And what it does is it keeps a high floor of pricing. So when I get the question about what's going to happen over the next 2 to 4 years of pricing, well, I don't know exactly what the Fed's going to do with interest rates, and I don't know what's going to happen with the world wars and all of this stuff that is happening around. One thing I do know is that we have a supply problem. And when you have a supply problem, that is inherently keeping a high floor for prices. And so what I'm very confident in, and we've said this for a long time now, is that home prices 3 years from today are going to be significantly higher than what they are right now. And I think that a little bit of that is missing the point too. The point here is if this asset class is right for you, you buy and you hold, and you don't really worry about what happens next year, the following year, or 3 years. You should be making, at the very minimum, 5-year decisions, but really 10-year decisions or longer.
And if I was to translate that into a feeling, right, like what you just said, right, we see the MOI data, we believe that real estate prices are going to go up. I think the feeling that is most common in this community is either, man, that house that I bought for $80,000 is worth $200,000 right now. I'm real smart. Or, man, that house that Denny bought for $80,000 is $200,000. I wish I would have done it then. What Gregg is saying from like a feeling perspective is this idea that if you are, if you get it, right, you get it. You understand that real estate is the place where most people make their money, like most Americans build their wealth. You understand this idea of buying and holding for a long time, and you are interested in getting into real estate. Buying today will give you that feeling tomorrow. The prices will continue to rise in that medium length range. We don't believe that they're going to drop in that medium length range, in that 2 to 4 year range that Shaquille was asking about. They will continue to rise. And the other thing that this show that we've talked a lot about is this idea that when interest rates drop, that is another thing that we see as an indicator that when the Fed is dropping interest rates, prices start going up, and not just prices are going up, but the demand for real estate, the buying frenzy starts to really, really happen. And if you're looking at this months of inventory data and it's telling you, okay, still got a really, really high floor here, don't see the bottom dropping out anytime soon. And you're also looking at indicators in the economy and the signaling from the Fed and the different things that are happening. And you're like, man, I think in the next year or so, interest rates are going to drop. Then the idea is locking in right now into the price that you can get right now before it continues to go up. And then refinancing later after the rates drop will allow you to lock in all this like equity right now and getting at a lower purchase price that you can then refinance later on. And just like Marilyn, whose rental income just went up because she had somebody renew and the raises rents, refinancing will create greater cash flow as well for you down the line.
Well said. I think there's a much higher chance of what you just talked about happening than the chances of home values going down.
Yeah, there you go. So last but not least, we got like 7 more really, really good questions I want to get to. Beyond these stats, beyond this MOI that tells us that the high floor is happening, beyond understanding that real estate isn't really a cycle as much as a repetitive pattern of growth, is other data points, GC, that we talk about a lot on the show. And that is the idea that the correlation between a thriving downtown and a city's revitalization.
Yeah. So if we understand the premise here that you almost kind of know the answers to the test as far as how much are your assets going to appreciate over a full market cycle. Question should be, is there anything that can bend that curve upwards?
Yep.
Is there anything that can take that from, call it that 4.8% or 5% growth rate and make that 5.2 2 or 5.5?
Mhm.
Because if that's the case, then you're talking about hundreds of thousands of dollars of additional return on investment for you. And there is something that can bend that curve. We know it to be true because it's happened a few times now across the country. And that thing that you're looking for is which downtowns have revitalized. Looking at the data, revitalized downtowns appreciate 27% more. They've appreciated 27% more than the overall US since 2013. And I've looked at Denver, Austin, Nashville, and Tampa, all downtowns that have become revitalized. And this is home values, again, since 2013. So we know there's something there. And when you have a change agent like that, that can bend the curve. And that is why this is such a special moment in Jacksonville's history and in your growth as an investor, because we stand on the precipice of downtown Jacksonville becoming revitalized.
This is one of the big reasons why our 120-person 2-day summit sold out in like a blink of an eye.
Absolutely.
It's because people want to come see this, right? We've talked for a long time about the idea that 10,000 residents in an urban core is the critical mass it needs for the flywheel to start like spinning on its own. You no longer need incentives from the city. All of a sudden, Whole Foods wants to be the corner tenant on a mixed-use high-rise with a parking garage, and stuff gets real easy for the average real estate developer out there, even in the short-term window. And what we've been seeing is this idea that downtown Jacksonville was hovering somewhere around like 3,000 to 4,800 for a really, really long time. And from like 2017 till now, it's been on this like rapid ascending growth, and this eclipsing of the the 10,000 person milestone is on the horizon, right? Like it is meant to happen in the next year.
100%. And so we have just gone from the macro. We understand that revitalized downtowns are what you need to look at if you want to bend the curve upward in your trajectory. Now we can look into the leading indicators. And so this resident population is a leading indicator that they looked at in Tampa. They looked at it in Nashville. They looked at it in Austin and Denver. And what we came to understand by going to these cities is that when you cross that threshold of 10,000 residents, the numbers start to pencil for developers. And when numbers start to pencil for developers, that means they can make money without city incentives. That's when all these bars, restaurants, amenities, Whole Foods start to come in. And that's when quality of life gets better. And that's when rents and home prices go up in the neighborhoods, those single family rental property neighborhoods. Home prices and rents go up at a very high trajectory because of what's going on downtown.
You say that because at the end of the day, JWB's population of homes are all single-family workforce housing homes within 15 minutes drive of the urban core where all this stuff is happening.
Exactly.
Right? So this idea that, is this a good time to buy if we're gonna land this home? Like, right, buy or sell? What part of the real estate cycle are we in? What I'm learning is not very different from what, Denny's got his own takeaway. He's putting in the chat, today's takeaway, buy today in Jax, get JWB to manage your rental property portfolio, and you will be a happy camper in 2034. Take it all from an investor who's been with JWB since 2012 and seen a full market cycle. Awesome.
Man, Denny, thank you so much, Denny. It's incredible to know and to be able to speak with somebody like Denny who has walked miles and miles and miles in your shoes if you're a newer investor, and has been through the ups and the downs of owning rental properties and has seen the other side, and he's lived what we preach on this show. And for all of you who are coming to the summit, Denny's going to be here. Yeah. So I know he's going to be one of the most popular men at the summit. Yeah, of course.
But that being said, so that's Denny's take. At the end of the day, I think how I would phrase it is the idea that what part of the real estate buying cycle are we in, buy or sell? The first thing that I think we learned today is the word cycle is problematic because it makes you think of buying a dip. There generally is no dip in real estate. It is a recurring pattern of growth with one minor exception that happened in like generational that we don't see on the horizon for us right now. So we see a continuing pattern of growth. And if you look at that and you believe that real estate for you, it's time to buy. If you zoom in and you look at the numbers of what is happening when it comes to months of inventory, which has been one of the key indicators that we have had access to here on the show that have allowed us to make contrary opinions that have been right a couple of times over the last really weird things that have happened. months of inventory show that the months of inventory are below historical averages, which correlates with higher than average home price appreciation. And then on top of that, you're looking at a city in Jacksonville, right, that is on the precipice of an urban core turning on. We're not the only ones saying this. The Urban Land Institute has called Jacksonville a future supernova city, which it's only given that designation to like the other cities that we just compared here, the Charlottes and the Austins and the Denvers of the world. I don't know if those are the exact cities that are supernova.
I don't know.
But the cities that you would go back and be like, oh man, I wish I bought real estate there 10 years ago.
Yes.
That's been doing it. And what we see by the numbers, by the insider data that we have, is that Jacksonville is on the precipice of a downtown turning on, which again will lead to higher than average home price appreciation for the foreseeable future. So if you came here to ask us our opinion of where we are in the cycle, buy or sell, it's what you see.
Buy, baby.
It's buy. All right, cool. Anything to add to that before we get into questions?
No, I
Cool.
think let's start crushing some
Cool.
questions.
Great questions. So Jag had a clarification. The all-in-one loan, trademark, is the only mortgage in America that provides you access to money for 30 years, recomputes interest automatically every night for 30 years, uses every penny you earn to pay down your mortgage, and charges you interest 21 days into the following month. It's like a 30-year HELOC. You ever heard of that thing?
Haven't heard about it.
Super
No.
interesting. Okay,
Yeah.
Maybe we should.
Jag, if you want to just send an email over to info@JWB Companies, we're happy to take a look into it. I will caution that even more important than the loan product, it is the teammate. And, certain lenders may promise the world, but they can't actually do the loans that we need to do for your turnkey investment properties. So there's more than just the product. But with that being said, if anybody has anything that they'd like us to take a look at, send it to info@JWB Companies. Our team will vet it out and see if we can bring it to you.
Cool. Patron Santorius, Michael Santorius, puts here in the Q&A, also seconded by Pedro Nacianceno. Do we have a chart like that chart that we just showed of home prices over time? Do we have that for rental prices?
It's a little bit more difficult with rental prices because where I get that data is from the multiple listing service, which for decades really only had housing price information. Rent price information was not usually used in the multiple listing service. So you can't really go there for a long-standing data, but that's where our consulting data, especially John Burns that we use, comes into play. So I do have some really good rental data. It might not be that exact same chart, but Michael, I know you're always have great ideas. If there's something you'd like specifically to go through on rent prices, just send it over in an email and we'll bring it to a future show for sure.
Yeah, I think Pedro seconds that when he says, "May I ask for an update on Jack's rental demand and maybe a little historical context would be nice." I think we just found out our next community generated show topic, GC.
All right, perfect.
All right,
Love it.
We'll put that together for show. Ty has a question. Ty, good to have you as always. I understand that real estate values will go up over time, but how do you guys think that pairs up with growing in affordability? Will people be able to afford and buy the homes of the future?
Great question, Ty. So this doesn't happen in a vacuum. Home prices don't go up in a vacuum because if you hold all things constant and home prices continue to go up, obviously it makes it less and less affordable. But there's a couple of ways that you can solve this problem and still have home prices go up like we are expecting them to do. The first is that you get some relief on interest rates. The reason why home prices are so unaffordable today, a lot of that is driven by interest rates being as high as they are. We do expect interest rates to come down, and that will ease home price affordability in that sector and will allow for continued home price growth without making them more unaffordable. But the big thing and something that is a big part of our message as to why we have invested $68 million of our own money in downtown is because the way to win for our entire community is to help raise median incomes. And our downtown projects are about raising median incomes, and that's what improves quality of life. If median incomes raise and you have top talent coming to downtown Jacksonville, and there are more and better jobs for people, home prices and rents can go up, and people generally are going to be okay with it. But you got to solve median incomes rising. And so that's the big opportunity and something that we're really motivated about and happy to be a part of, especially with downtown's growth.
Yeah, Ty, I love the question because I also, my wife is a urban designer, right? And we think along the lines of like placemaking and community and society and all that type of stuff. I would say, two things to add a little context to it. Number one, if affordability is what you're most concerned about. I think that's a very real concern. And I also think that that is a national concern.
Mhm.
And we happen to, in Jacksonville, be less affected by that right now because we are still considered an affordable city, right?
Yeah.
Like there's many, many places in the United States right now that affordability thing, it's like way overdue to address.
Mm.
My hometown is one of those, Miami, right? Like that idea. Second is, I guess it was like a week or two ago where you came up with that whole economic flywheel thing. You want to just kind of like recap like what Gregg is talking about of like working on increasing average, like average income. We just did a show that was basically how do you raise rents without hurting residents.
Mm-hmm.
And the summary of that thing is this idea that like, even in that there is a flywheel for doing that correctly. And that is the approach that JWB has taken. And right now, there's no secret that there is a moment of pain in that flywheel, right? Like rents have gone up considerably, but this idea of what was it? Do you remember the components of it?
Yeah, absolutely. It starts with really rising population and better jobs. It's really kind of where it starts if you think about it on the top. As a natural part of that, what you're going to see is that rents are rising. Rents rise. And that is the most difficult point, especially for residents in a community, right? And that's what a lot of our residents are feeling right now. But if you think beyond the here and now, that is a natural part of this cycle working. And where the cycle quickly goes is to rents supporting new development, because you need higher rents in order for these long-term sustainable value add projects to make sense for somebody to go in and invest their money to develop it. And so rents have to go up in order for bigger and better and nicer things to come to the community. And so that's the other part of the process. And you start to see bars and restaurants and grocery stores and other amenities start to happen in your neighborhood.
Arts and culture and stuff like that.
Culture, right? And we're so excited again for the summit because we're going to see a real life example of that entire circle happening on the summit when we talk about the shopping center that JWB has developed and brought a grocer, Winn-Dixie, to this shopping center, taking what once was a food desert for 17 years in our local neighborhoods here, bringing a grocer back and bringing over 100 jobs to that location. And so that is the cycle. We have to be able to see beyond that with a focus on raising median incomes again. And you do that through better jobs and population growth.
Yep, got it. So that is the economic flywheel, right? That we're going to see it. I keep thinking of like the summit. It's almost like economic development safari, where you see the whole circle of life.
I like that.
So yeah, super excited to like showcase all that. All right, Vi Desai's got a couple of good questions here. Thanks for taking my previous question. Do you also offer a way to get into commercial real estate?
We do not. Our bread and butter and what we love and we focus on is single family rental property investing. We think it is the best asset class and not one that needs to be overlooked. So that's what our bread and butter is. We also offer private lending opportunities, which allows us to do our development that we do, but we don't offer commercial investments.
Cool. And Vi also says, I have 2 properties with JWB and both were new builds. Thing I am confused as if I should pay for annual termite treatment. Do you have any data on that?
Oh, geez. Vi, let me put you in touch with the teams that we can get a specific answer on that for you. There are certain properties that we do need to make sure that we pay on a regular basis for things somewhat related to termite treatment and other things. And then other properties we don't. So if you would just go ahead and reach out to your portfolio manager, we'll get a specific answer for you on that. Or you can just send an email to info@jwbcompanies.com.
Got it. All right. Anonymous Tunde is back.
All right.
How does this chart compare to total US? Just curious.
How does that chart compare?
Is that home price appreciation?
Yeah, the entire country saw a bubble, right? Yeah. And then they saw a trough. And so if you look over the entire country for the last, call it 40 years, you're going to see very similar to what you saw for the Jacksonville chart. Slow recurring growth in those years, not named Great Recession. But you just don't see declines very often.
Cool. And then Anonymous Tunde also asks, Gregg, did you always live in the Jacksonville area or did you move there for investment opportunities?
No, I went to the University of Florida.
Go Gators.
And there you go Gators. I got a job with Johnson & Johnson. I thought I was going to be the corporate guy for a long period of time, and it didn't work out that way. But that's actually what brought me to Jacksonville. Got here, read Rich Dad, Poor Dad, got my best friend, Alex Afakis, who's our president. Together, we kind of came up with the idea of starting a company like this, found mentors, found education, found people that were better than us in our real estate investing careers. And, 18 years later, that's how we are here and of course, committed to Jacksonville long term.
It's such a good question because even in our group of friends, right, our like spike ball crew, there is multiple guys that have moved here to Jacksonville for investment opportunities from New York and from other places, right? You just happen to have been here for 17 years.
Nobody thought about that 18 years ago. Jacksonville was like on nobody's radar 18 years ago, but now we are.
The better Gregg Stone. As median income goes up, is there a point where we may need to do a major renovation to draw residents to be able to rent our properties?
Is there a point where we may need to do a major renovation to draw residents to be able to rent our
basically as median income goes up, is there a certain time where like these homes that we're all buying in as workforce housing, are we going to be like out of the right asset class, I guess is.
Yeah, I guess I was just a little bit thrown off as median incomes go up. I think if the question is like, should you plan to do a major renovation after 7 years or 10 years or 15 years? I guess I'll kind of attack the question from that perspective. Things break over time. And so you can look and say, okay, well, your roof should be good for 15 or 20 or 25 years. You can kind of look component over component, but we're not like ready to do a major renovation at year 5 or year 10 or year 15. What you do is you just plan appropriately. You use the data flywheel to inform your decision. So we know over time, how much should you set aside for upcoming maintenance expenses and prepare appropriately. And that's how the replacement schedule would go. With one caveat, your biggest expenses are generally when people move out of your homes, right? That's when you're going to have more maintenance expenses. So you're going to get a pop like that every 4.5 years on average for if you're a JWB client, because that's how long on average your resident stays.
Cool. All right. Last question. Gordon Butler asks, how comfortable are you with the JWB investments in downtown development? What are the projects in addition to the shopping center is JWB involved in?
Oh, Gordon, I hope you're coming to the summit.
Question.
That is
you'd never ask.
Perfect question. How comfortable am I? Well, it's but what we have been eating, breathing, sleeping for the last 3 years as far as putting our own money on the line, but for years before that, as we were kind of planning for this thing. So certainly something that we're comfortable and excited about. I think this is a special time because we can bring you all into it now. There were years and years and years where I couldn't bring you all into what was happening because it was under wraps. Because as you go and you would try to acquire 20 blocks of a downtown, you can't just go out there and tell everybody what you're doing, so that we were able to lift the veil last September, and it's been really fun to coordinate our message for why single family rental properties makes so much sense with the message of what is happening in downtown Jacksonville and what effect that will have on your single family rental property investments. So, and then Gordon, I just hope you're going to be here on Friday and Saturday, because that's what the tour is going to be about. You're going to get to see, feel, touch, experience these downtown projects as we go on this walking tour.
Gordon, the shorter answer of all that, because I think you just got Gregg overly excited, is they have, apart from that Arlington Shopping Center, they have a cluster of buildings, right, where the Sweet Pete's, the Federal Reserve, and 418 Church Street, something like that.
218 Church. Close enough.
I'm not a numbers guy. They have a cluster there. They've essentially bought 20 blocks of downtown Jacksonville. You didn't catch that, right? So they have one cluster that's already activated. We are going to walk what's going to be called the Pearl Street District, which is essentially like a kind of like square 5 blocks neighborhood that's coming up from the ground up, all kind of like staged to be around a $1 billion plus investment.
$2 billion.
$2 billion plus investment, where the first 500 million are coming out of the ground right now and getting really, really enabled. And that's going to be all this mixed use stuff. And the last thing that I would say beyond that, right? So the rest of those 20 blocks, I'm sure, are going to get developed at some point. But, what I find really, really unique in all of it is that you can ask JWB how comfortable they are in their downtown investments. And you might ask other big time developers if they would make the same investments, and you might get 2 different answers. And me coming from Miami, where the term real estate flipping was basically invented by big time developers down there that had very short-term win horizons that didn't really work out so well for residents of Miami. I'm one of them. I left Miami, right, because of many different reasons of affordability and things that I just didn't see right there, is the fact that JWB has this perfectly aligned incentive to have a long timeline to bet really big over a long time on this stuff. And that is, number one, they're all young guys that are raising young families here. And you can talk to their president, Alex Safakis, and he'll very unabashedly tell you that he wants his kids to graduate college and the best jobs to be in Jacksonville so that they can live here. Right. So, like, I think emotionally they're very aligned with it. But beyond all that, it's the idea that they've realized what we just talked about. A booming downtown raises property prices. And they have this business model that is perfectly vertically integrated. And this is the next level of vertical integration. This idea that they can invest in downtown at a price and at a return that a typical developer would be like, yeah, I don't know if it's worth the effort. But for them, the idea that they're going to get that return plus the 6,000 properties that they manage around Jacksonville, around the urban core, plus the 300 that they themselves own, are all going to have increased rates of home price appreciation. And on top of that, they're going to get the return of what they're doing in downtown. To me, that is super, super unique in this like alignment of like win, 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 win for the community, right? Like they're going to win as big dog real estate developers as they do that stuff. But us smaller dog real estate investors that own, all the chips around the table that are also betting on the pass line, more gambling analogies
There you go.
that are also betting on the pass line of the Jacksonville economy get to win because we bought this workforce housing. And then on top of that, the community gets to win because what they're really doing is placemaking in downtown, attracting higher paying jobs, raising the median income, driving amenities for residents, and raising the quality of life, which is going to continue that flywheel for all that stuff. So just wanted to throw that out there.
I love it. I just think, for us, we're not interested in creating a win-loss scenario. We're not even creating win-win scenarios. Yeah. It's that triple win that is really motivating us. That's where you can really make an impact. And so that's kind of where our head is.
Very cool. GC, heck of a show, man. We had 90
fun.
plus people show up today, man.
Amazing. You guys are incredible.
We're an hour and 20 minutes in and still got 65 plus people here.
I think so.
We never take it for granted that you show up here, middle of the day. Like I said earlier in the show, the value is the community. The value is these great questions that you ask, these different ways that you poke at it, allow us to explain it in ways that we didn't know we had to explain it.
Mm-hmm.
And that really, really helps us. It makes the show easy for us to do. And it makes it a lot of fun to have you guys as all friends here. That's why we're so pumped for the summit coming up in 3 days. Really excited to get a whole bunch of hugs in.
Yeah,
right?
It's going to be great.
Just a lot of hugs, a lot of familiar faces, a lot of reunions of people that, have made an impact in each other's lives by showing up to a Zoom chat. And I really can't wait for it, man. It's going to be awesome.
Me too.
In the meantime, you're not coming to the summit, but you do want to take that step forward, chat with jwb.com to get this thing rolling for you, right? Get your questions answered, understand the context of your own situation. That's what it's like. It's not a sales call. You're not even going to be allowed to look at properties for like 3 calls. It's really just about like, does this make sense for you?
Sure.
So go to chatwithjwb.com and get that thing started. Thursday, last show before the summit, we are talking about why workforce housing makes better investment.
Oh, yeah.
Homes. There is a misconception. I was prey to this before. When I private lended with JWB in 2014, I remember getting on the phone with your team and be like, I want something by the beach because I like the beach. But, I think we're going to have some not your average perspective there of how these workforce housing in the urban core perform better than other ones that have these other benefits. So we want to see you there on Thursday. And from there till now, any advice, GC?
Don't be average.
See you on Thursday.
See ya.